All right, let's continue. So, yeah, we're doing equity valuation in this chapter. Okay, so we're trying to estimate the value of equity of a corporation. Okay, equity valuation. And what we talked about last time was the dividend discount model. It's just a model that theorizes that the share price should be equal to the present value of all of the future dividends. Okay, so it's a reasonable model, but it's not applicable in all situations. Okay, so that's where these other models come into play, and we'll talk about the other two today. Okay, to briefly show you, let's say we have a balance sheet that represents the assets, liability, and equity of a corporation. Okay, so what the dividend discount model did was the dividend discount model basically tries to value one piece of equity of the corporation. Okay, so the share price, that is the price of one share of equity, right? Just one share, not the entire equity, was equal to the present value of all of the future dividends. Okay, so yeah, this is what the dividend discount model said. The present value of the future dividends, since shareholders get those dividends, should be the share price. Okay, so this dividends took many different forms that we talked about. So it could be just a regular perpetuity. So dividends don't grow but go on forever. In this case, we used the PVP formula, right? Dividend over RE. Okay. And we also did an example where the dividends grow at a constant rate. Okay, so it could be dividend in year one. This starts growing at a rate g. Okay, so dividend 1 plus g to the second power, and so on. Okay, so that would be a growing perpetuity. Dividend just happened to be in the form of a growing perpetuity, but we're still dealing with dividends, right? In this case, we would use the PVGP formula, present value of a growing perpetuity. Okay, but we're still using the dividend discount model here. Okay, yeah, but as I said, the dividend discount model, I'll just write it here, dividend discount model is a good model. It's reasonable, but it's not applicable in all situations. Okay, for example, I'll just say not applicable in all situations. It's still a good model. Okay? So, for example, you guys know Tesla, right? Tesla doesn't pay any dividends right now. Okay, so its policy is to retain all of the earnings within the firm so it could invest in R&D and future growth. Okay, so rather than paying cash to shareholders, their policy is to retain all the earnings in the firm. Okay, so Tesla doesn't pay dividends. So suppose that you're trying to use the dividend discount model to value the share price of Tesla, then you would have something like this on your timeline. Doesn't pay any dividends, so it doesn't matter what R is. P should be 0, right? According to the dividend discount model. But you can look up Tesla's price. Tesla's equity value is pretty valuable. Okay, so it's not 0, right? So for firms like this, dividend discount model cannot be applied. Okay, so we're gonna use something else. Another example is some firms pay dividends but not to their full capacity. Some pay dividends, but not to their full capacity. Let me give you an example. So suppose that there are two firms, firm A and firm B. So we'll say these are identical firms. They operate in the same industry. Their firm size, asset size is the same. They have the same product, same revenue. Everything is the same. The only thing that's different is their dividend policy. Okay, so we'll say net income for both firms is $100. So their dividend payout policy is different. So firm A retains nothing in the firm and pays everything to shareholders. Okay. So of the $100, they'll pay everything to shareholders, whereas firm B chooses to retain $50 in the firm to fund future growth and pays out $50 to shareholders. Okay. So if we use the dividend discount model, we'll be using this number and this number to value the shares of A and B, but this could be very misleading, right? If you think about it, if we do dividend over R, assuming a regular perpetuity, dividend over R, PVP basically, firm B's value will be half of that of firm A, okay? So that's not really accurate because they're the same company, same profitability, same revenue. The only thing that's different is their payout policy, right? So in these cases, using the dividend discount model could be misleading, right? So yeah, so these are a couple examples where the dividend discount model is not applicable, meaning using it will give you misleading results. So here, for these cases, we're going to use something called the discounted free cash flow model. Okay, discounted free cash flow model. And what it does conceptually is, so we're going to talk about something called the free cash flow. Okay, so and taking the present value of these free cash flows will give you something called the enterprise value. Okay, so I'm going to use a similar format as I did right here. Okay, so current share price was the PV of dividends, right? And we were trying to estimate a piece of equity using the dividend discount model. Here, we're going to try to find what's called the enterprise value. Enterprise value is basically this entire thing. We're trying to get the market value of assets. We're going to come back to this. But market value of assets, and how do you get it? You'll take the present value of free cash flows. Okay, so we'll talk about that too. But the ultimate goal is still to try to value the equity. Okay, we're still trying to value this equity values. Okay, so we're trying to get first get the market value of the entire equity, and we can estimate the share price as well. Okay, so what we're going to do in the discounted free cash flow model is first get the enterprise value, and then since assets equal liability plus equity, we're going to deduct liability and get the value of equity. Okay? Yeah. Okay. And lastly, sometimes firms just don't have that much information, publicly available information. Could be a private firm, or yeah, some firms don't have enough information to apply either of these two models. Okay, In which case, so not enough information. In which case, we're going to try to estimate the value of equity by using the third method, valuation using multiples. Okay, so we're going to do the PE ratio method, and this is real easy. Okay, yeah, so that's what we're doing. So yeah, examples 2 and 3 are dividend discount model examples, and then let's do the discounted free cash flow model. Okay, so first let's do some definitions. So the enterprise value is the market value of the entire firm. Okay, so based on the little balance sheet figure that I showed you just before, we're trying to get basically the market value of the entire assets. Okay, that would be the enterprise value basically, and it's also the takeover price. It's the net cost of acquiring the entire firm. Okay, not just the equity. Okay, so if someone were to come in and acquire the entire firm, they would have to pay this much. So it's the takeover price or the acquisition cost of the entire firm. Okay, so the relationship that I showed you earlier over here was that market value of assets is basically the enterprise value, and it's the present value of all of the free cash flows, right? Free cash flows. I'll define free cash flows here. Right here. Free cash flows. We'll just say it's the cash that's available. Cash available to be paid out to all investors, meaning creditors and equity holders. So in this course, we'll just say all investors mean bondholders and shareholders. So roughly speaking, if the firm makes, let me use a different color. If the firm makes $100 of free cash flows in a given quarter or a given year, maybe $30 will go to shareholders, and the rest might go to bondholders. Okay, something like this is just a rough illustration, just trying to show you that free cash flows go to both types of investors, shareholders and bondholders. Okay, that's the key. Okay, so cash that's available to be paid out to all investors is the free cash flow. Okay. And here's another important point. Since we're trying to get the present value of all of the free cash flows, we need to discount the free cash flow somehow, right? So in this class, we're always dealing with time value of money. Here, the dividends were discounted using RE, right? The return on equity or the cost of equity, okay? That captures the risk that shareholders face. And if you recall, in bonds, in bond pricing, we took the present value of the coupons and PV of the par value, but the discount rate that we used was RD, right? RD, or yield to maturity, okay? And that captured the risk that bondholders face, or the rate of return, okay? So here, when we were trying to discount the free cash flows, we gotta find the right R. Okay, what R do we use? The R that we use to discount free cash flows is called the WACC. Okay, this is the R used in free cash flow discounting. Okay, so WACC stands for the weighted average cost of capital. Okay, weighted average cost of capital. Okay, basically I'll show you the formula later in the later chapter, but we're taking the weighted average of the RE and the RD. Okay, so if the firm is 100% equity financed, the weighted average is just RE, but usually a lot of times that's not the case. So we take the weighted average. Maybe 2/3 of the firm is equity financed, and maybe 1/3 of the firm is debt financed, and there will be something called the interest tax shield component, which we'll get to. But we're taking the weighted average, okay, weighted average cost of capital. Again, conceptually, this is because free cash flows go to both shareholders and bondholders. So we're going to capture the amount of risk that these classes of investors face. So we're going to use the RE, the risk that equity holders face, and RD, that the risk that the bondholders face, and take the weighted average. Okay, weighted average cost of capital. Okay. So yeah, for enterprise value, there are two formulas. Let me clear this. Two formulas are this. Again, this is analogous to share price being equal to PV of dividends in dividend discount model, right? So the exact form of cash flows might be different. It could be a perpetuity, regular perpetuity, growing perpetuity, some irregular pattern. Doesn't matter. We're just gonna get the PV of free cash flows discounting using WACC. Okay, and enterprise value is also equal to the market value of equity plus debt minus cash. Okay, so if you recall the balance sheet, basically market value of equity plus debt, and if we assume no cash, that's exactly equal to the market value of assets, market value of the entire firm, right? So I hope the formulas also make some sense. Okay, so EV is this, and it's also this. Okay, so in your formula sheet, maybe have something like this: PV of free cash flows. That's also equal to, market value of equity plus debt minus cash. Okay, and this little formula comes from this formula. Okay, I'll show you here briefly. So if we do shares outstanding times P, that's basically the market value of equity. Okay, so let me do it here. The share price of one piece of equity times the number of shares will give you so one piece of equity times how many shares there are will give you the entire market value of equity, right? So this is market value of equity plus debt minus cash was EV, right? The notations are a little confusing here. I apologize. But EV here is the same thing as V. I don't know. I was following some textbook. I should probably fix this. But this is enterprise value. Okay. So we had enterprise value we're adding back cash. That's why we have plus cash. We're subtracting debt. That's why we have minus debt. And then we're dividing by number of shares to get the P by itself. That's how the formula is formed. Okay, so this is the share price formula using the discounted free cash flow model. Okay, it became all messy, but I'm just trying to show you how the formulas are constructed, and hopefully they make some sense. Okay, let's see. Okay, so example 4 and 5 deal with the discounted free cash flow model. Okay, the solutions are already posted. And before we move on to valuations using multiples, let me just do this real quick. So during the regular semesters too, I always draw this table for the students, and this table will be very useful because on the exams, on exam 1, I basically gave you an R, okay? So you just had to use that R in your calculations. Starting in exam 2, for some questions, I'm going to have you choose the right R for the calculations, okay? For example, the problem could say, problem 1 could say, firm XYZ, blah, 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 and then I'll give you, or whatever this is, I'll give you some type of a cash flow, okay? I'll just write it as cash flow type. And then I'll give you what the cash flow looks like. It could be a perpetuity or an annuity or some random stuff. And then I'll give you multiple R's in the problem. I'll say the return on equity or the cost of equity is 6%. The return on debt or the cost of debt is 4%. And the WACC is 5%. Okay? And I'll have you calculate, estimate either the share price or the bond price or the enterprise value. Okay? So your job is to see what type of cash flow you're dealing with, basically who gets them, so you can choose the appropriate R, choose one of these 3, or I might give you RF too. And then estimate the value, whatever it's asking for. Okay? Now this looks all confusing, but I'll give you the table so it'll be easier. Okay? So this table will be useful. You want to use it in your on your exams. I'll have cash flow type, recipients, who gets these cash flows, and I'll say appropriate discount rate. Okay, so this is also a conceptual review of what we talked about. Okay, so far we've talked about many types of cash flows. So this is different from the cash flow pattern types, which are annuities and perpetuities, irregular, and so on. Okay, so this cash flow type, what I mean by this is we had, I'll just say U.S. Treasury coupons. Okay, so these are the coupon payments from a U.S. government bond. We also had corporate coupons. I'll just say corporate bond coupons. So the coupon payments that come from corporations, corporate bonds. Okay, and then we talked about dividends too, right? Dividends. Basically, shareholders get these, right? And then today we talked about free cash flows. Okay, so these are the different types of cash flows that we talked about. And the reason why I make a distinction is because the risks associated with these cash flows are different, right? Let's first talk about, who gets them. I don't know if I should draw maybe, doesn't matter. Okay, who gets them? So here, treasury bondholders. So people who hold the US government bonds, bondholders. Yeah, and we said US government bonds are considered risk-free securities in real life, right? So the discount rate would be RF, the risk-free rate. Risk-free rate. Okay. So when you, I hope you're getting this. So if we are trying to value the price of a US Treasury bond, then we take the present value of the coupons, and these coupons are discounted using RF. Okay? And who gets the corporate bond coupons? Corporate bondholders. So corporate bonds are, relatively safe, but it's riskier than US Treasury bonds, US government bonds, right? So the discount rate for these cash flows will be the RD. Okay, so this is exactly the YTM if it's an annual bond, right? So related to the YTM, I'll just say. Okay. Dividends. Who gets dividends? Shareholders get dividends. Shareholders get dividends. And we've already established in the previous video that shareholders face more risk compared to bondholders, right? Because of the uncertainty of cash flows and residual risk. Okay, so RE, they face more risk. RE we're gonna use. Okay, so here, I'm sure most of you are following, but if we're using a dividend discount model, the dividends are discounted using RE. Okay, just as I mentioned earlier. Free cash flows. Who gets them? If you were paying attention, you'll know that bondholders and shareholders. Okay. So here we're going to use the weighted average cost of capital. We're going to take the weighted average of the RD and the RE and then get the WACC, the weighted average cost of capital. Okay? Yeah. Okay. Again, the WACC formula looks something like this. Oops. We'll talk about this later. You don't have to memorize this or write this down for the second exam, but on the third exam you'll need this. So we're taking RE and multiplying it by how much of the firm is financed using equity, plus we're going to take the RD, and there's this thing called the interest tax shield component. We'll talk about that. But how much of the firm is financed using debt. So we're taking the weighted average. That's all we're doing. Okay. And lastly, we've already established that RE is greater than RD. But we now have something new, WACC, right? WACC, if you understand the math, mathematically, WACC has to be somewhere in between RE and RD, since we're taking the weighted average, okay? So I'll just say if it's 100% equity financed firm, it could be equal to WACC, RE and the WACC, but in the real world, there shouldn't be any cases where the firm is 100% debt financed, so we'll just keep this strictly greater than, but everything is greater than the risk-free rate. We already talked about the risk premiums, right? All of the risky securities have this format. Okay, so all the risk premiums make it greater than RF, greater than RF, greater than RF. Okay, so this is a good little overview of the conceptual things that we talked about so far. So hopefully you use this and you find this useful. Okay. Let's do the last one. Okay. So again, we're still doing equity valuation. So another title could have been equity value estimation. It's trying to emphasize that no one truly knows the value of equity. Okay? It's hard to pinpoint the value of equity, and also because that's also because new information comes in the market constantly. Okay, macroeconomic news and firm-specific news. So the equity value changes all the time. So we're trying to estimate the value of equity. So one thing I want to mention is that all these models are reasonable, but there is no single model that's better than all others. Okay, so I would say no single model is superior. I gotta be careful than all others. So what I'm trying to tell you is that I would say dividend discount model and discounted free cash flow model is probably better than valuation multiples, but this is also useful. So you should not rely on one method is what I'm trying to say. Maybe shouldn't rely on one method. Okay. Ideally, if you're an analyst trying to value or estimate the value of an equity, you would use all three models and some other models to get a range of reasonable prices so you can inform the readers. Okay, so yeah, we did the dividend discount model and then discounted free cash flow model. Lastly, we'll do the valuation using multiples, and this is especially useful when you're trying to estimate the equity value of firms that lack information. Okay, so all these things require a lot of information, right? For the discounted free cash flow model, you have to know the assets, liability, and to calculate the free cash flow, you also need information. We might not get to this chapter, but there's a way to estimate free cash flows from the financial statements. Okay, so unless you have all the details, you cannot apply these models. So publicly listed firms have a lot of details, but some private firms and some firms might not have information. Okay, no info. In that case, we're going to use valuation using multiples. Okay, let's talk about that. So yeah, so basically we're trying to value equity based on comparable firms. Okay, so yeah, so method of comparables or comps is estimating the value of a firm or a project based on the value of other firms or projects with similar cash flows. Okay, so some pros and cons. Pros, you'll see that the calculation is easy. Okay, it's too simple. Okay, so if anything's too simple, it's probably not that accurate. Okay, that would be the con. Okay, not that accurate. It's just a rough estimation. But since it's very easy and easy to understand, also people use it often. Okay, so you'll see that the PE multiple is mentioned all the time, and there are other multiples as well. But we're gonna use the PE multiple. We're just gonna cover this one in this class. Okay. Yeah. So the idea is, let's say there are two firms, firm A and firm B, and they're both producing the same product, and they have similar size, similar we'll just say similar cash flows. Okay, so very comparable firms, ideally in the same industry for sure. So we cannot compare a firm in the, I don't know, firm in the consumer goods industry against a firm in a technology sector, right? So we want to compare similar firms. We'll just say firm A doesn't have much information. We know its products, but the inside operations we don't know, not much financial information. Info is hidden. Okay? Whereas firm B they're in the same industry doing similar things and similar size, but they're a publicly listed firm and they have all the information. Assets, net income, dividends, all kinds of information. Okay? So the idea is we're going to use this firm's information to infer the value of equity of firm A. Okay? That's the general idea. Okay? That's why we have valuation based on comparable firms. Okay? So we're going to use the valuation using the PE ratio. So the PE ratio is new, but it's pretty simple. All it is we take the price per share. That's the share price. We've been talking about share price, right? And then we divide it by earnings per share. Okay? So the earnings per share is basically net income divided by number of shares. Basically, if the firm makes $100 and there are 100 shares outstanding, each shareholder, one piece of equity gets $1 each. Okay, earnings per share. Okay, so that's the PE ratio. PE ratio, price to earnings ratio. Okay, so this is basically what we're doing here. If we're trying to value firm A's price, so this is the firm that lacks information. Okay, if we're trying to value firm A's price, we're going to look at the benchmark's PE ratio. Okay, that is, in the example you'll see later, right here, we're trying to get the share price. We're trying to get the share price of Pepsi, assuming that it doesn't have information. We do that by looking at the PE ratio of Coca-Cola and then multiplying it by the EPS of Pepsi. Okay, so you'll see the solution that's posted, but price, we're trying to estimate the value of A by using the earnings information of A. We need that. Okay, but we multiply it by the PE ratio of a publicly listed benchmark. Okay, calculation is real simple. You'll see that this problem is real easy, but for the exam, I'll show you, you need to look at the practice problem set. There aren't that many problems, but for some reason, a lot of students skip this, and you'll see a problem that's similar to this, but in a different format. There, I give you, I don't have it right now, but I give you a table. Firm 1, 2, 3, 4, 5. I give you which industry they operated in. So industry A, industry A, industry B, industry B, industry A. Okay, and then I give you the PE ratios. Okay, so if the problem asks, I'm trying to value firm 7, which operates in industry A. Okay, here you want to ignore the information for industry B, firms that operate in industry B, because they're not comparable firms. So you want to look at firms 1, 2, and 5, take the average P ratio and then go from there. Okay, so you'll see the detailed solutions there, but make sure you take a look. As long as you do this, you will get the problem right. Okay, yeah, and example 7 we're gonna skip. Okay, good.